Do you ever get paid and feel like the bank isn't the best place to keep your money? Well, this is the video for you. We're going to be talking about 7 different places where you might want to put your money. If you follow the steps we'll be talking about, then you'll be in a much better position financially. Welcome to Modern Wealth, where the primary goal of this channel is to help people grow financially. We help people save money, invest money, and make more money so that they can build a better financial future. So let's get started with this. First, it's important to understand why so many people who are making almost $70,000 per year or more are still struggling financially, and why is it that they're still in large amounts of debt? We tend to ask questions like, is it the economy pitted against them? Is there a massive wealth gap? What's actually the problem here? Although all of those different factors can have an effect on people's ability to pay their bills, what it really comes down to is that most people don't understand how to manage their money. These things aren't taught in our schools or by our parents. In most cases, because some of our parents are in the same financial pit that other people may end up in. It becomes a system that trickles down, and so hopefully I can provide some more insight. First, let's talk about a place you want to consider putting your money in once you get paid. This is usually your retirement fund. Now, if you're in America, you could take advantage of something like a 401k plan that may be offered through your employer. But if you don't have a 401k plan, there are other options as well. However, taking money out before you can even see your paycheck could certainly help you build that future that you may be looking for. I mean, let's face it, one of the worst things in the world might just be running out of money before you pass away. If you ask me, I would much rather be alive than dead, but still, at that moment, you want to think about the idea of running out of money before you die. It's certainly a depressing thing that actually happens to people. So even if you're in your 20s right now and you think, well, I'm not going to retire for another 40 years, what's the point in saving for retirement? Think again. To be honest, this is the perfect time to do that. Just putting away 5 to 15% of your money before you even see your paycheck into something like a 401k is something that you may want to consider now. Just keep in mind that there are risks involved with any financial decision that you make. So any investment that you're going to make, there are going to be risks involved, which is why you need to make your own financial decisions as to what you're going to do with this. But still, this is an idea that a lot of people take advantage of. Sadly, some younger people, especially when they first start their jobs, opt out of the 401k. They opt out some of these pre-tax retirement funds that they can invest into and end up really hurting themselves in the long run. Now let's move on to the second one here, which is that after your money gets shaved off for your retirement fund, the money should be going into a checking account. This is going to be the hub for everything that happens. It starts off with your paycheck going to the checking account and then you paying your credit cards and everything else. That's essentially your savings. You don't really have to consider anything past that, but what I'm encouraging you to do is think that you're going to have a lot of things coming out of your checking account in 2 different areas. What's really going to be important is that you can have automatic withdrawals into various different areas like different bank accounts. Having just one bank account could be a mistake you want to consider having multiple contingencies. So again, putting money into your checking account is important because this can be your hub for everything that you want and do. This is important, but not necessarily for everyone. For some people, they might not get automatic deposits into their account from their employer, so it would be wise to request to get paid in cash or maybe get in an actual physical paycheck. In a lot of cases, however, it's the optimal choice to actually get money directly deposited into your account because then you can automatically withdraw money. You can set it up without having to physically go to the bank, hand them a check, then go and cash the check. It saves time, money, and effort. So if you can, you should try to strike a deal with your employer about depositing your money into that account. Now let's move on to the third one here, which is going to be very important. This is essentially paying for your necessities. Now when I say necessities, we're talking about the bare bones necessities, the basics, if you will. We're not talking about a TV nor about you wanting to buy an Xbox for your nephew for Christmas. We're talking about the essentials like food, shelter, transportation, healthcare, and utility. Most of these expenses depend on where you live and how many kids you have, or even your current situation. To be frank with you, this really shouldn't be an excessive amount of money. First things first though, you need to understand the difference between needs and wants. In the most basic sense, needs are the things we have to have in order to survive. These are the things I mentioned above, like food and shelter. Wants, on the other hand, are some of the things we can do without but are interested in having at the moment. One need that I find very important, especially among Americans, is healthcare. I think things like healthcare and health insurance are something that people will skimp on because they think they're going to save some money. If you're one of these people, I advise you to stop thinking that way. Nothing could be more important than your health. It could even be something that could end up hurting you in the long run. So be sure to understand your necessities and pay for them, nothing else. On top of this, you do want to consider paying those minimum payments as well on your cards. We'll talk about that later, but basically, it has to do with paying anything that's not going to affect your credit score. If you are skipping on minimum payments for credit cards or things like student loans or mortgages, that's going to hurt you both in short term and long term. If something happens and you don't have any extra money to pay it, then you'd be in huge trouble. Now, this brings me to the next and fourth place, which is your emergency fund. Everybody should have an emergency fund regardless of whether you have $1 million in your bank account or a negative $100,000 to your name. Having an emergency fund is going to be one of the first steps to alleviate some of that financial stress you may have at the moment. It might even be the most crucial step. Now, before we move on to an example, make sure to hit like and subscribe. It'll really help the channel out and motivate me to keep creating videos like these. Just be sure to watch until the end for a few more amazing tips and tricks. Now, back to the video. Let's say we put the fund at $2,500. This could be $500, $1,000, or even $10,000. It's really up to you. Now, over time, it's nice to build this up. A great strategy to get the ball rolling is to just start by taking $10 out of every paycheck, or taking $20, $30, or $40 out of every paycheck, and then putting it into a separate emergency fund that is very easily accessible. I know some people might not like the easy access because it doesn't help them be frugal, but you want to be accessible because this is for situations where it's a true emergency. Things like maybe you don't have any cash on you but you need to get a tooth removed because you're in a lot of pain. That would be an emergency. Since this is only for emergencies, you want this to be liquid. The best bet you have of keeping it this way is putting it somewhere like a separate checking account or maybe a separate savings account. You could also consider doing it in cash, but I wouldn't consider having $2,500 cash laying around. However, as I said, you can start with a smaller amount of money like at $500 or $1,000 and then build it up over time. It'd be great especially if you have a family. Then maybe you'd like to consider getting this a little bit higher, like closer to $5,000 in case something happens. Now, even if you're in debt, this is still important to have, because if you're at the $0 mark and you don't have an emergency fund, you'd have to keep getting into crazy amounts of debt that wouldn't be a good look for you. With that being said, let's move on to number 5, which is paying off your debt. As soon as you build that emergency fund, you could start to get your footing a little bit, and you might want to consider how to actually pay off your debt. Now, there are multiple ways to do this, and depending on what type of person you are and depending on how much debt you have, there are 2 different strategies. One of them is called the debt snowball method, and the other one is the debt avalanche method. For a lot of people who are really struggling financially, they have large amounts of debt and they're struggling to actually stay motivated to pay it off. If this is happening to you, then you may want to consider using the debt snowball method. This is essentially what is going to be your go-to for multiple debts. Let's say that you have 5 different types of debt, namely a home mortgage, student loans, personal loans, maybe credit cards, and even a car loan. So what you do with the debt snowball method is you're going to tackle the one that has the lowest balance. Let's imagine that your car loan only has $1,600 left on it. so you tackle that one first, regardless of the interest rate. Then let's say that your personal loan has the second lowest amount. So then you tackle that one, and then you go down the list tackling the one with the lowest amount of money that you owe. As you go down the list, you're essentially eradicating those different types of debt until you start to have less and less types of debt. It certainly is something that can make you feel better once you start eliminating those different types of debt, because when you're paying 5 or 6 or even 7 different types of debt and paying all these different bills at the same time, it can be something that can be really difficult to stick with. Having piles and piles of debt can be something that is actually mentally draining. As you continue to have debt pile on top of each other, the thoughts will probably never go away. It'll probably be something that stays at the back of your mind, creeping up on you. What's scarier is that you know that you're procrastinating and you might start feeling guilty. People do that with loans, and they try to avoid these loans by no longer taking calls from debt collectors or no longer opening the mail knowing that they are past due on some of their different loans. They try to ignore them, but the longer it goes on, the worse it gets. You can never truly be comfortable, which is why getting them done little by little, step by step, is the best course of action. Now, the second method is the debt avalanche method. Logically, this makes more sense since it is going to save you more money. However, it depends on what type of person you are and how much you can actually focus and discipline yourself. The debt avalanche method is somewhat the same thing as the snowball method, where if we say we have different types of debt, we tackle them one by one. The difference is that instead of tackling the lowest balance debt first, you're going to tackle the highest interest rate from these different types of debts. So let's say that in your credit card bills, you have $20,000, but the interest rate has gone up by a pretty large amount, where you have maybe, $1,600 in your car payment and something in your personal loans. The rates have gone up by, let's say, 20%, and you're paying a lot more than you initially got. So you decide which debts have the highest interest and you begin paying them off from there. You're essentially doing the same thing as the snowball method, but you're tackling those high interest rates first while still eradicating one debt at a time. And get this, you'd still be paying the minimum payments for all these different types of debt, clearing them steadily. Again, you don't want to default on keeping these credit card loans because that's going to drastically hurt your credit score and end up costing you late payment fees. In the long run, it's really going to bite you in the butt. So step number 6 is going to be what I would say is probably the most enjoyable step of this entire process, and that is by saving up at least 4 to 8 months of payroll. First, let me tell you a quick story about Bill Gates. When he started Microsoft, he found that he was struggling to please investors. He found that in some cases, investors would be putting a lot of pressure on him, so what he did is he saved up enough cash from Microsoft so that he could pay all of his employees for an entire year. He had a year's payroll on hand, in cash, so that he was able to pay all of his employees. If the company wasn't making any money, now the reason for this is because he realized that there are going to be times when maybe they put out a product that is not as great as what they thought it would be, and maybe they're not pulling in as much as money as they thought they would, and they would still be able to pay their employees while doing this. This is something that I learned about and realized that if you have a job and you're taking that for granted right now, it's because we have a really good economy at the moment. However, things can go south really fast. Think about it. 10 years ago, there was a recession and a lot of people were losing their jobs with an unemployment rate of almost 10%. But if you're self-employed, then you'll have to understand that there might be times where things go south, like maybe when your income drops pretty significantly. So, it would be ideal to have some money in your bank account and not just a regular bank account where you essentially lose money. We're talking about something that's going to keep up with inflation. My go-to is usually something along the lines of an online savings account. You can get them for over 2% interest on those, and that should essentially keep up with inflation. It's something that is quite steady and gives you peace of mind knowing that if you lose your job today, you can live off of this money for half a year before you get a new job. One thing I like to do, which you can also consider, is putting money into a money market account or possibly even CDs. I'm not a big fan of CDs because they lock your money in there for a certain length of time. But something that's keeping up with inflation but is code steady is putting money into investments like the stock market or bonds. I prefer these options because they're a bit steadier and a bit more predictable. Now that we've talked about all of the places to keep your money, I'd love to hear your thoughts so far. Before we move on to the last one, make sure to comment down below which ones you might consider, or you could tell us what we missed out on. Anyway, without further ado, let's talk about the last one, which is, wait for it, investing. Now this is how you can truly get your money to work for you. For number 6, talking about money in that bank account that's netting you 2.5% interest is probably not going to make you rich, but it's going to be a nice thing to hold on to. Investing is going to potentially make you rich, but I mean you'd have to be dealing with real estate, stocks, bonds, and other types of investments. There are some riskier investments like cryptocurrency. Whatever you are personally into and whatever you are personally knowledgeable on is something that you can consider dealing in. However, if you have large amounts of debt like a credit card debt or one that has upwards of 9 or 10 or 11% interest, then you want to consider paying that off almost entirely before you actually start investing your money. That's because the average return of the markets is about 7 to 10% per year. Obviously, it varies quite a lot, so you want to keep that in mind. Now that we've covered investing, these are all of the 7 steps that can help your money grow. It's good to reward yourself sometimes with good things like a vacation, but only after all 7 of those steps. You have to pay yourself first before you can start doing all these other things. This is probably the main reason why the poor continue to stay that way. They're not spending their money wisely and keeping track of it. They usually just spend most of it on entertainment and leisure, and travel and all kinds of different things that aren't necessities. So, always remember, money management is number 1 in building your wealth. Pay yourself first, then invest money, and you might find yourself in a much better financial position for the rest of your life. If you found this video helpful, make sure to like and subscribe. Thanks for watching, and if you want to learn a few more tips and tricks to handling your money or your money-making skills, make sure to subscribe. We'll see you in the next video. Cheers!